weak period for stocks. According to the Stock Traders Almanac, the S&P 500 has averaged a 0.4% decline during the month of September. That's the worst of any month, and much of it comes in the second half, which of course begins next week. Now, some of the volatility stems from quadruple witching, and that of course is about to happen 50-something minutes from now, right? I mean, you're talking about quad witching, which only occurs 4 times a year. It's the expiration of stock index futures options, stock options, and single stock futures. September's losses typically happen from here on out, and checking how far we've done so far this month. Well, yeah, we are in the red with the Dow down 2.25%, the S&P lower by a full 2%, the Nasdaq off by about 1.5%. But could this year be different? Why? Well, the Federal Reserve's Open Market Committee has a crucial 2-day meeting next week, could be the most widely followed meeting of the entire year. And on Wednesday, the FOMC is expected to give the clearest clue yet as to when it will start tapering, which is scaling back its $120 billion in monthly bond purchases. Knowing that, will this September be different from the ones in the past? Let's get right to our floor show traders, because we don't know. I mean, Tom Hayes, Chris Robinson, I will start with you, Tom. Will this month be different, particularly because you have that issue coming out from the Fed next week, and that could gyrate things in one way or another?
Yeah, well, Liz, a lot of people are talking about seasonality this year, and what we learned from experience is when everyone's looking for the same correction is when it often doesn't happen. We do think that any pullbacks are going to be contained to 3 to 5% until the Fed takes the punch bowl away or starts to at the end of this year, or more likely early next year. We think more likely early next year. Earliest would be late this year. So the November meeting and probably an implementation in December. And what we're going to see when they signal next week is that yields are going to continue to rise. The 10-year yield, just like happened in 2013 when they signaled in May and finally actually implemented in December, yields went up from 162 basis points to about 3% on the 10-year yield. I think we could see a move towards 2%. And that sets the stage for the reopening trade to come back. We're at an inflection point here, Liz. Value stocks performance relative to growth over the summer has fallen to the lowest level since last October, right before the election. And we know what happened next. Yields went up 100 basis points over the next 5 months, and value had one of its greatest outperformance periods from October through May of this year during that period. So next week, there will be no implementation, but I think there will be a signal. They're going to say, we want to move this ahead before year end if the data permits, and yields will start to climb. As a result, we want to take some profits on some of the tech stocks that have done well over the summer. We want to get some reopening exposure in anticipation of rising yields. We like cruise lines and we like airlines. Norwegian Cruise Lines, their booking and pricing trends have been better than pre-pandemic of late for 2022. And United Airlines, even with Delta, the TSA numbers have been averaging about 75% of pre-pandemic, and that's without business travel largely and without international travel in a major way. That will come back as people get into the offices later this year and early next year.
Chris, do you think this September will be different from the previous ones that the Stock Traders Almanac always references, saying, oh, September's the ugliest month of the year? Everybody thinks it's October. October's volatile, but September's really the worst on balance. Will this time be different? And if not, either way, where are you looking to invest at this point when it comes to advising clients?
Well, the biggest thing is, since the low of the panic back in 2020, we're up 109% in the S&P. If you pull up a chart of the S&P, and a lot of people out there, when you start talking about technicals, their eyes glaze over, but there's some pretty good research in it. Jack Dreyfus, who started the first mutual fund, he was a big technical analysis guy. But people have been looking at the 50, the 100 and 200-day moving average. If you pull that chart up, you can see we've been basically climbing that 50-day average since the recovery. So coincidentally, that 50-day moving average is about a 2.5% correction. Then the 100-day moving average is about a 5% correction. and the 200-day would be a 10% correction. So you've got everybody watching the same thing. And your first guest said the exact same thing. When everybody's talking about a correction, that's not when it happens. The corrections come when nobody thinks it's going to happen. So I'm happy to hear people say we're looking for a correction. That probably means it's not going to come. As for what the Fed's going to do, it makes me think of, and I raised a couple kids, and when they're 2, 3 years old, you got to tell them it's time to go to bed. It's time to go to bed. They're going to tell us they're going to stop the tapering 8 times, 9 times before they do it. So I wouldn't hold my breath on that. I watch the 10-year every day. I traded it every day for years in the pit. We're sitting at 1.3%. The big boogeyman percentage is 2%. If it gets there, we'll see if that impacts stocks.
Well, let me tell you, the NASDAQ's taking the outsized hit right now. It's down about 1% or 151 points. And there are a lot of people who think just stay in tech. That's the way to go. But we appreciate, no matter what happens, that you guys are with us to guide us. Tom, Chris, thank you very much.
Thanks.
And
Thanks,
coming up, the stock tide